was house oil and throw in China. Tom, oil and China were believed to be tailwinds at the start of the year. Energy was coming in, China was reopening. Are they headwinds now at the back end of 2023? Most people would assume they are.
What they are, and this goes to data dependency, there's something that's happened in the last 14 days. Maybe it's 20 days, I'm not keeping at count. But this surge that we've seen in oil, with Javier Blas looking at Saudi Light near $100 a barrel. I saw a 97 quote on Saudi Light spot, I think 48 hours ago. That's new, and that's new for the people at the Eccles building. They are data dependent, but it's just not economic mumbo jumbo. It's what's going on in the rest of the world, including China.
Neil Dutta of Renaissance Macro wants the last word going into the Fed decision.
He's one of our best guests.
Dutta writes in, this is wish casting from the Fed. They are wish casting a soft landing, but the reality of 2023 is that we have not landed at all. We're running at an above trend cruising speed. We'll get the forecast from the Federal Reserve in about 20 seconds time alongside that Fed decision. Going into it, the price action looks like this on the S&P 500, positive by 0.2%. On the Nasdaq, almost totally unchanged. To the bond market, yields on a 2-year shaping up as follows. Near in and around 5% on a 2-year in America, 5.05%. Mike McKee has the decision.
This is the very definition of a unanimous hawkish pause. The Fed leaves rates today in the range of 5.25% to 5.5%, while saying growth is solid and inflation elevated. So higher for longer. Policymakers leave another rate move on the table for this year and take 2 reductions off the table for the next 2 years. The statement once again discusses, quote, the extent of additional policy firming that may be appropriate. And the dot plot shows that 12 members of the Open Market Committee still believes they will raise rates by another 25 basis points this year. The high dot at 6.25% comes out of the dot plot with St. Louis Fed's Jim Bullard's retirement. For 2024, the committee now sees a median effective Fed funds rate of 5.1%, up 50 basis points from their June projection. And for 2025, 3.9%, up from 3.4% in June. The long-run neutral rate is unchanged at 2.5%, although the central tendency range moves up to 3.3% from 2.8%, and the dots show 7 members think that neutral is higher than 2.5%. All this because the Fed sees stronger growth, lower unemployment, and lower core inflation ahead. The economy should grow 2.1% this year, they say. That is up from 1% in their June forecast, more than doubling. They say next year growth will be 1.5%, up from 1.1%. Unemployment will finish this year at 3.8%, down from their June forecast of 4.1%, and in the next 2 years end at 4.1%, down from 4.5%. PCE headline inflation will be 3.3% this year, up 1/10, basically on energy concerns, but their core PCE forecast falls to 3.7% from 3.9%. Next year, it falls to 2.6%. And one final note, no change in QT, no change in the IOR or repo rates.
Mike, stay close. I'm just going to work through the price action. So off the back of this decision, we're negative by, let's call it 0.2% on the S&P 500. As you might expect, the Nasdaq underperforming. If you turn to the bond market, yields were lower almost across the curve at the front end as well. They're now higher by 3 basis points. Looking at, staring in the face of the potential of closing at new cycle highs on the front end. 5.1287 turns to 5.13 on a US 2-year. So yields up, new cycle highs at the front end of the curve. And the dollar off the back of it, a whole lot stronger. The euro against the dollar, 106.89 on the session, positive still by about 0.1%, but certainly off the back of that decision, a stronger US dollar. Mike McKee, I want to come to you on that median dot for 2024. Are you basically telling me the Fed took back half the cuts that were priced for 24 in their previous projection?
That's basically what I'm telling you, John. They were looking at 4.6%, and now they've gone up to 5.1%. Clearly, they think the economy is strong enough that they may need to do more. At least that's the message they want to send to the markets.
Mike McKee, I look at the growth forecast. You went through them quickly. Maybe they don't make the headlines. I think they should. Frame out again their growth vision, as Neil Dutta says, their wish casting for 2024.
Well, the biggest change is 2023. This year, obviously, the way things have been going, they need to mark up growth for this year. They call it solid. 2.1% is their final growth. But growth next year is 1.5%. That's up from 1.1%. That's a fairly strong change. So they do see perhaps the wish casting that Neil is talking about, the idea that growth can be stronger into next year, and it does certainly suggest the idea of a soft landing.
I look, Michael McKee, at where we are in this, and it gets to November and December. I know your first question to the chairman will be, tell me about November. Mike McKee, tell us about what this translates into for the next meeting.
Well, it's definitely going to put the markets on guard, depending on what kind of data we see, especially in the inflation numbers. The Fed's acknowledging that we're going to see a little bit higher headline, a little bit lower on the core. And if that's what we get, then the Fed could decide to raise rates. It's hard to know exactly because of the energy components that are coming into this, but that's what to watch for when we get the CPI and PCE numbers. The other, of course, joker in the pack is if the government does shut down and there is no data, the Fed will have to use its own kind of methods to figure out where it thinks inflation is.
Mike McKee, thank you, sir. We know you've got to run and get to that news conference. Mike McKee's going to sprint to that. It begins in about 25 minutes' time. Just to go through the forecasts again, that is a monster upward revision to GDP. But they're market to market at the Federal Reserve. So they go from 1% to 2.1 for 2023. Tom, the story for me is out in 2026. The story for me on unemployment, they've got it at 4% and PCE back down to 2%. All the way out there, several years away, and this is the aspirational, fanciful stuff that this is how it's going to happen. Unemployment for this year, by the way, 3.8% is the forecast now, and it only climbs to 4.1% next year. Bruce Kasman talked about this a little bit early this morning at JP Morgan. Tom, how high does unemployment need to go to get inflation lower? That's going to be a question we could explore in the next 25 minutes or so. But the Federal Reserve is telling you that they can get back to target 2% in several years' time, and unemployment's going to be in and around 4%.
I'm going to go with Duddy here and combine it into what Matt Lazzetti said. I got lucky in that I picked out a Matt Lazzetti's note, his first look at 2026. I don't even know if there's a first look to first quarter 2024. The uncertainty here, off the pandemic, off the shift from a supply analysis to a demand analysis of the economy, and that's a pretty clumsy move. John, looking out to 26 now, maybe they're forced to do that, but boy, that's a tough thing to do. Let's do this, and we're very lucky today to do this because we can fold in what you're all reading and feeling about the strike in America. Diane Swank is steeped, I should say, in Midwest economics, her tenure at Bank One, and of course her academics at Ann Arbor. Andrew Hollenhorst with us as well. Diane Swank, I guess the chairman has to mention the strike today. How do you fold strike analysis into the chemistry the Fed has?
It's really tough. I don't think it, first of all, the strike is very targeted. We'll see over this weekend how far the strike gets. I think many people are worried about how long the strike will last, and that is important. It both suppresses economic activity, of course, constrains inventories, but it's constraining inventories in a different way than the chip shortages did. So I'm not as worried about vehicle prices being the push on inflation that they were, that some people are, given that this is a more limited kind of production hit, and it actually gives market share to other producers out there. At the same time, demand has fallen quite dramatically for new vehicles because financing rates have gone so high. I think what's really important in what the Fed just did was the whole concept of higher for longer, much higher for longer, and potentially a higher neutral rate on the other side of this. This is what the theme was coming out of Jackson Hole Symposium, was how synchronous the idea of higher for longer mantra is across the developed economies, that even as we approach this peak in interest rates, that the central banks are emboldened because of the resilience that we've seen even in those economies that have suffered recessions, have not been as bad as they expected, that they are emboldened to hold rates higher for longer. And there is a concern on the other side of this that they're going to need a higher neutral rate. This is a different world than the world that we left in 2019.
Far different, far different. Andrew, at the start of this hiking cycle, we asked a pretty important question. Can we get inflation down to target without doing too much damage to the labour market? Overwhelmingly, people said we couldn't. We've made some progress without killing off the labour market. The Federal Reserve today, Andrew, is extrapolating that out. How hopeful, Andrew, is that forecast?
I think that's the big question that these forecasts raise. You have 2023 growth revised materially higher. You have that strong growth continuing into 2024 now in their forecast. So you have an economy that's running at or above potential. You have an unemployment rate that's historically low. And yet we're meant to believe that wages and prices will cool in this economy. This just contradicts basic macroeconomic theory. So this is a forecast that does not line up with traditional ways of forecasting the economy, with the relatively intuitive idea that when labor markets are very tight, that pushes up wages. And when labor costs are rising, that pushes up prices. So I think this is a difficult forecast to square with the reality of how economies behave. That's to be addressed at a later point. I think what the Fed did today makes sense in the sense that we're running strong growth, we're running inflation that's above target, so it makes sense to guide towards higher for longer. So they achieved the hawkish skip. If that was the intent, that's achieved. I think in terms of the forecast, there are some real questions that need to be answered.
The hopes and dreams of these forecasts, Dan, let's sit on it. I remember a word that you used maybe more than a year ago. You referred to the forecast from the Federal Reserve as fanciful. Aspirational was a word we heard again this morning, repeated through this afternoon. Dan, when you look at these forecasts further out, do you think it's the right approach to extrapolate out current dynamics, which essentially is the following? Inflation can come down, can come in further without doing real damage to the labour market?
I think it's a great idea, and I hope they're right. I do think it is still fanciful. One of the things that I think that the Fed is betting on is that we are seeing the high-frequency data as the labor markets have cooled. This has been one of the most dramatic, frenzied pace of a labor market and then cooling that we've ever seen, with unemployment still very low. And what they're counting on is the high-frequency data on job postings shows that wages are slowing even more rapidly as we go into fall. So they're betting on those things, helping them. At the same time, we haven't seen in decades as many strike actions as we're seeing right now. And that's where things like the current strike with the UAW, the strike that we're seeing in healthcare, the strikes that we're seeing ongoing with the actors and the writers union, those things will have an impact. And how much we see the cost of living adjustments baked into contracts going forward is going to be very important. Remember, with the pop in energy prices, we're going to see an increase. The September CPI is what sets the numbers for Social Security bump in January.
Right.
That's one of the reasons. It's going to be a higher bump now. That's one of the reasons we had stickier inflation at the start of this year. And so that could be a sticking point and be harder for the Federal Reserve.
Andrew Hollenhorst, you need a victory lap right now. We got a 5.13% two-year yield. I've got a 10-year real yield any moment to pop through 2%, 1.99% right now. How does our economy, how does our business society, how does it adapt to a 2% real yield? Is that a signal of buoyancy and resilience, or is that a signal of trouble to come?
You know, we've seen the economy a lot more resilient to higher interest rates than I think many people expected at the beginning of this rate hike cycle. And part of that is that a lot of the debt that's out there is fixed rate debt that doesn't mature for many years. You think about 30-year fixed rate mortgages, many of those are still at lower rates. You think about some of the corporate borrowing that's taken place, and that also hasn't all been refinanced yet. So as that debt is refinanced, you start to have people, individuals, and firms experiencing higher rates. That should slow the economy.
Right.
You see credit that's tightening. So there is a sense that this is slowing the economy, but it has to be sustained. And I think that's the message in the dot plot.
For Bloomberg Radio Worldwide, bring up the chart again on television here that we just put up with the 2-year yield back to before the pandemic. And this is an arch call by Hollenhorst, and Swank was very good at this as well. Andrew Hollenhorst, we're back to yields that I remember and Diane Swank doesn't remember. The consensus belief out there is, OMG, we're all going to die with this yield structure. We're going to a 6% 2-year Hollenhorst yield. Are we all going to die?
Well, remember the 2005 to 2007 period. This was an extended period of time when the economy performed relatively well and we sustained higher yield levels. And it wasn't that long ago, but it just feels like a long time ago, and many people haven't experienced that yield environment. So I think this is kind of rediscovering that economies can continue to grow, continue to produce inflation at higher yield levels. Eventually, these levels may be restrictive enough, sufficiently restrictive in the words of the Fed, to cool the economy, but that's a process that can take time.
Diane, you're one of the best at this. Give Mike McKee a little bit more help. What's the question for Mike, for this chairman, in this news conference that starts in about 15 minutes' time?
I really want to know about how they're so optimistic about growth for next year, given some of the headwinds that we face going into next year, everything from higher oil prices to student loan repayments, and the additional tightening that they expect in the pipeline, not only in the banking sector, but more broadly. So, that 1.5% is really pretty stunning, with 0.5% higher on short-term interest rates. That's remarkable resilience with the cooling of inflation, and I'm just trying to square all that all comes together.
Yeah.
Oh, Diane, we all are. We're trying to figure this out. Diane Swank there and Andrew Hollenhorst, two of the very best on the Federal Reserve. That news conference starts in 15 minutes. If you're just joining us, welcome. Special coverage of the September Federal Reserve decision, live on TV and radio, a Bloomberg surveillance special alongside Tom Keene. I'm Jonathan Ferro. The decision, unchanged, no change on rates of the Federal Reserve. The focus on the projections of this Fed, a monster upgrade to GDP for this year, in many ways marking to market. No news there. We understood that growth was better than expected through much of this year. They understand that now. The new projection is 2.1%. The old projection was just 1%. An upgrade to the GDP forecast as well for next year too, for 2024. That goes from 1.1% to 1.5%. Some of the projections elsewhere are pretty fascinating. 12 of the 19 officials on the FOMC still forecasting, plotting an extra hike this year in 2023. In 2024, the median dot, we priced out half the cuts they had projected in the previous set of forecasts. But ultimately, it's the soft landing hope and dreamed. The decision, Tom, today is to extrapolate out current conditions. The idea that we can get back to target, all the way back to 2%, without seeing unemployment climb much higher than 4%.
We had a banner up moments ago on television here, and I did the quick nominal GDP math, and this is basically out 24 months, out 36 months, out to when we turn into a pumpkin. John, it's simple. They're looking at 4% nominal GDP or lower. And there's a lot of people looking at the spirit of this economy saying that with disinflation that maybe strengthens the economy. And it's to bust Bramo's chops, it's a toxic brew.
It is a toxic brew. But for them right now, there's nothing toxic about those projections.
I can't get out to 25,
Max Kettner.
26.
We said Max Kettner, HSBC. Yeah. He started talking and we said, that sounds like Goldilocks forever.
Yes.
Aren't those projections Goldilocks for the next 12 months?
I would.
The rest of this cycle?
I would say so. And what's interesting here, folks, we're coming to you from London, is, those of you on TV can tell the sunset is spectacular tonight. I went out on the sidewalk in the rain here, the lovely afternoon rain.
How did that work out for you?
Of London, practicing for Bank of England tomorrow. And this jumble that we're seeing right now in America is the same exact theoretical jumble we're going to see tomorrow with the Bank of England. These people are making it up as they go.
Let's turn to the price action and see how much Chairman Powell has to say in the news conference that starts in about 13 minutes. Your equity market totally unchanged on the S&P, slightly negative on the Nasdaq, but this move in the bond market, Tom, let's sit on that. The 2-year cycle highs
that's a key thing.
Through 5.1%, just like that, up by 3 basis points on the session, Tom. Yield on the 10-year, not much price action there, 434. 30-year, let's call it 440 TK on the long bond.
Let's bring it in right now. This is very important. PGIM's Greg Peters with us on yield, and Jim Bianco with us with Bianco Research. Jim, let me go to you right away. I just think this is so important. There's a sense of longer. I see a nominal GDP call out 24 months, which is not longer. It's that finally rates come in. Do you buy it?
Well, I buy the idea that you want to be looking at GDP, nominal GDP, as being a benchmark for long-term interest rates, but I'm not buying this idea that nominal GDP is going to fall to the levels that they think. If I was to describe, this confusion that we seem to have about this Fed policy, they're almost arguing that nothing of significance happened in 2020 and that we're going to return back to normalization, is the word we like to use that's replaced transitory, and go back to something between 2010 and 2019 where we can have 2.5% real growth, 1% to 2% inflation, 4% nominal growth, and that would bring everything down and you'd have Goldilocks forever. But I'm not so sure that that's the case. I think that the economy has changed since the shutdown restart in 2020, and the Federal Reserve is still struggling to come to grips with that, and they're still thinking we're still in the last cycle.
Greg, you've got to work with real money here. The decision to extend duration, to find the belly of the curve, all the other professional stuff you do at PGIM. Does the language and the nuance of the forecast and the dots, does that change your conviction in what you're doing with your portfolios?
Well, I would say that we're finally getting what we've been thinking for quite some time, and that is higher for longer, right? The markets have been raging against this notion that rates will remain high. All the forward curves are pointing down, the dot plot pointing down. So I think this really throws cold water on that. And so for us at PGIM, we really think it's a higher for longer. We never felt the need to jump into duration. Maybe it's closer to that now, but more in the back end of the curve. So, look, I think the Fed delivered exactly what they wanted to, provide a hawkish sap that allows them to speak more dovishly and perhaps not move rates higher here.
Greg, it's not just the high for longer message that jumps off the page of the SCP. It's the growth inflation mix looking out a year, 2 years, that they believe you can get back to target 2%, and unemployment's going to drift higher, maybe to 4%, and basically stop there. Greg, that has big implications for how you invest elsewhere, beyond rates, bonds, and to credit. Is that your outlook, that basically we can achieve back to target inflation, barely shaking up the labor market in any way, shape, or form?
Well, it is very aspirational. There's no doubt about it. That is a Goldilocks type of outlook. If you have an environment where, rates remain higher, but growth is quite robust and inflation's coming down, I think that is a fantastic investing backdrop. I do think we're pretty close to it. The challenge, of course, on the table is all these different uncertainties and cross currents, and that has not gone away by any stretch of the imagination. So, we need to take these forecasts with a grain of salt. There's no different than our own forecasts, right? They're rife with uncertainties, but I do think there's a distinct possibility here, at least directionally, and I feel pretty good about the outlook.
Jim Bianco, do you feel pretty good about the outlook?
If we're talking about the outlook about the Fed, I have my issues with it like everybody else, but to feed on something that Greg just said, let's be real. We all have forecasts, and most likely they're all wrong, but that's okay because we're not being expected to predict the future. The key is whether or not we can adjust. We can see that, okay, the data's coming in not as we expected, and we need to adjust these forecasts. Now, the Federal Reserve in the last couple of years has not had a good track record on that. We can all remember transitory. And what I'm afraid of with this Goldilocks forecast is when the situation comes in that it's not panning out, they're going to dig in their heels and continue to say it will, and they might wind up making another transitory type of mistake in 2024. I'd like to see Chairman Powell, show some flexibility with these forecasts to say, look, this is what we think now. But if the circumstances and data comes in soon, that's out the window and we're going to adjust. And that, like I said, that is okay. That is what you should do with a forecast, not just keep at it because you're afraid of some embarrassment of having to change it.
Jim Bianco, the laureate Paul Krugman, with a wonderful essay on disinflation, and he really emphasized what the Fed doesn't look at, which is plain vanilla inflation. Are they just in the fog of London, in the fog of Washington, the fog of across America, are they missing a disinflationary tendency in place?
I I don't necessarily think they are missing a disinflationary tendency. I happen to be in the camp that inflation on a year-over-year basis, I'm talking about headline CPI, has bottomed for the year. It's going to drift towards 4%, not much higher than that.
Wow.
Energy prices are going to be a big factor in that drift higher, and that will be enough maybe to give us that one more rate hike that they're looking for, and to at least justify going from 4 to 2 cuts next year. And I think that if that continues, that the December update of this plot will probably take those 2 cuts away as well. So I'm in that inflation is sticky camp, and that the Fed is going to have to come to the realization that they're not going to get close to 3%. So the disinflation that they're hoping for, that inflation comes down, the unemployment rate could stay at 4. It's been described here as fanciful, and I would also be in that camp too, that it is fanciful, and we'll have to see whether or not that type of situation unfolds.
John, moments ago, rounded up the 10-year real yield to 2%. This speaks to Dominic Constantine-Mazzuo's idea of we are restrictive.
Forgive me for thinking out loud, gents. There's a very simplistic approach to markets. You get economic information, data. You think about what it means for the Fed, and you trade accordingly. Now, Greg, I wonder if that's just changed off the back of these forecasts from the Federal Reserve. And let me go one step further and explain why. The first Friday of the month, we'll get a payrolls report. And if that payrolls report is hot, typically we'd sit there and say, well, labour market pressure, higher inflation, Fed has to do more work. But Greg, hasn't the Fed just told us, haven't they just de-emphasised the importance of the labour market to the inflation conversation?
Jonathan, I think that's putting way too much emphasis on the SEP and the forecasts. I mean, at the end of the day, we're in this data-driven world. The Fed is trying to balance that out. And I think the markets, given the fact that we're in this data-driven world and we're not getting what we're wanting in terms of clarity out of the Fed, we're relying a little too much on this data release. So I don't think anything changes. I think if the data change, I think the Fed policy changes. And, it's also important to remember 2 things. One is that, they don't have inflation going down to, 2% until 2026, which is, quite some time from now. And then 2, we just had a massive revision of GDP in this year. So, let's use that as kind of a reminder that forecast error is really quite high here.
Jim, what are your thoughts on the same question?
Yeah, if I could give you a cynical thought, that is that let's see if we even get a payroll report on October 6th, because if we have a government shutdown, the BLS is closed, and Mike McKee's sitting in front of an empty building on that morning. So leaving that aside, I do think, though, that if you're talking about the payroll report, the consistency about it it's been much stronger than we've been looking at for the last 14, 18 months or so. All but something like 2 or 3 of the reports have been above consensus. And that seems to be the trend that I would think would stay in place. And if we see those kind of numbers come in, it's going to push everybody firmly into that, away from that Goldilocks and into that higher for longer camp as well.
We got to make some money to get home here, John Farrow. Ian Lingen, the screaming buy of the 10-year yield, just says this is a Fed doubling down on soft landing. Mr. Lingen, of course, at BMO Capital. Greg Peters, if they're doubling down on soft landing, for you at PGIM, is the 10-year yield a screaming buy?
No, I don't quite understand that logic, to be honest with you. I mean, what that would presuppose is that you'd have a healthy dose of cuts in response to that soft landing. So, no, I think yields are relatively range-bound here. I don't really see a big move either way. Yeah, it does look a little oversold. There's some technical dynamics, but ultimately on a medium-term basis, it looks pretty fair value to us. So I don't think the bond market, investing in the bond market is not about capital appreciation. That is a pre-pandemic trade. It is about roll and carry. And so, no, I don't expect it as a screaming buy.
With that in mind, Greg, if there's a pool of money, people sitting at home right now, they're sitting on the front end, they've been told by a couple of people that they should worry about reinvestment risk in the next 6 months and allocate accordingly further down the curve. Are you saying relax, patience, you're fine where you are?
Yeah, so I've been saying that the whole time. No one wants to listen to it, right? I think there's been this tendency to jump back into the pool because these higher rates are going to evaporate. What the Fed has told you today, what the markets are finally starting to respond to, is that no, these rates are actually around here for a while. So, so I don't think there's any reason to rush. And so we like duration, but we wouldn't go hell's bells. Sorry.
And let's fold this into Jim Bianco. I mean, John, it's just simple. Bianco was way out front with this idea of defining what longer looks like with a 10-year yield, and he's in the camp with Greg Peters.
Hey, Jim, this was great. Jim Bianco, together with Craig Peters. Thank you, guys. Going into this Federal Reserve news conference with Chairman Powell in about 90 seconds' time. I can tell you the 2-year, the high of the session, 514.80. We've backed away since then, Tom. We're up by 2 basis points to about 511 at the front end of the curve.
For those keeping score, the third week of August 2007 is when the follies began. And there is a headline in the Bloomberg now of a 2-year yield back to 2006. Lapels were wider in 2006. John, I can honestly say, I guess I would, say historically, someday you're going to revisit 2006. Did I think we'd see it off this pandemic now? Never.
At the front end of the bond curve?
No, this is a big deal. And again, I'm going to go, folks, from the nominal yield that we're all living. What does this do to mortgages? And I'm going to go to the real yield analysis, printing 1.99 up to 2% right now.
We've spent 30 minutes or so, Tom, talking about these forecasts from the Federal Reserve. Any moment from now, Chairman Powell's going to walk into the room, stand behind that podium and deliver his statement and take some questions. On those forecasts, let's reflect on the Mike McKee question of the day. How much confidence do you have in anything that you were telling us today? Well, and Greg Peters said it. We're putting too much emphasis, Tom, on those forecasts from this Federal Reserve.
This is the Latin mumbo-jumbo of ex ante and ex post, and there's never been this much ex post, this much data dependent. I think we're going to hear that across 3 central bank meetings through the week here in London. These people are living ex post because of pandemic, because of a massive fiscal stimulus in the United States, not in every jurisdiction, a war in Ukraine, the endless litany that we have. But the heart of the matter is we're ex post.
The Chairman Powell walks into the room at the Federal Reserve on the September decision.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace, and so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Based on the Consumer Price Index, or CPI, and other data, we estimate that total PCE prices rose 3.4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. In light of how far we have come in tightening policy, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by 0.5 percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal child care funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question, by deciding to just maintain the rate and await further data.
So right now it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying, no. Clearly what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and we're seeing progress, and we welcome that. But we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation, really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that it's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from The Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next two meetings that we have between the end of the year. So it wasn't like we were arguing over that. People just stating their positions. And really what people are saying is, let's see how the data come in. You know, we want to see, you know what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, you know, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the two things. Those are our two mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced. You know, they want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, you know, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
I see. And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you know, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. You know, we've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, you know, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate, and now that we're getting closer, we have the ability to proceed carefully.
Let's go to Steve.
Steve Leisman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another half a point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, you know, we know it by its works. We only know it by its works, really. We can't you know, the models and that we use, ultimately you only know when you get there, and by the way the economy reacts. And again, that's another reason why we're moving carefully now, because, you know, there are lags here. So it may of course be that the neutral rate has risen. You do see people. You don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that you know, that the neutral rate at this moment is higher than that, and that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters. Thank you. So you've said several times that the economy needed a period of below-trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment. And that's because we're seeing that rebalancing in other places, in, for example, job openings and in the jobs worker gap. You're also seeing supply side things. So that's happening. I would say, though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market. That can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for supply. That's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase. And but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path, really, to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path is narrowed and it's widened, apparently. Ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible, and I also think this is why we're in a position to move carefully again. That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that. And we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say you know sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates, And so what are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policies work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think what, as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say, if we get to that level. And then the question is, how long do you stay at that level? And that's a whole other set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage we're at, though.
But it looks like because there was an across-the-board drop in the core PCE inflation projection for this year, and even then it seems possible the core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year, as we see inflation, kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. In the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
Thanks so much, Chair Powell. Neil Irwin with Axios. I wonder, how do you think about the question of whether the strong GDP growth we've been seeing is driven by excess demand versus supply-side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's, you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But it's the strike, it's government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other. But we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation. But that's really going to depend on how broad it is and how long it's sustained for. And it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that. And it also depends on how we'll be learning, I think, over the course of the next intermeeting period, much more about that. And the same is true for the others. I don't know if you mentioned shutdown. I think of all of these as being on the list. We don't comment on that. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time a sustained period of higher energy